Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our webinar today on Unsecured Personal Loan. Has the cycle bottomed out? We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Ashish Goyal, co-founder and CFO at Fibe. Mr. Hemang Mehta, Chief Risk Officer at Vivriti Capital Limited. Ms. Shruti Aggarwal, co-founder at Stashfin. This session will be moderated by Mr. Vineet Jain, Senior Director at CareEdge Ratings. We will commence this session with a presentation by Ms. Akansha Jain, Assistant Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Akanksha to make the presentation.
Thanks, Mamta. And I welcome everybody to the CareEdge Ratings webinar on unsecured personal loan. Has the cycle bottomed out? The growth and asset quality of unsecured personal loans has been a matter of discussion in the market. In the recent quarters, a lot of noise has been going around in the unsecured personal loan sector on the back of high growth witnessed in FY23. The sector has attracted attention of the regulator, and we have seen quite a few actions. The heightened scrutiny by the regulator has made investors more cautious, leading to a slowdown in the growth rates. To discuss these developments in the segment, we have compiled a short presentation to facilitate panel discussion. We request participants to key in their questions in the question box on their screen if you want them to be addressed by the panel during the discussion. I now begin my short presentation. In this slide, I summarize key points covered in the presentation. The growth in the unsecured personal loans slowed down to 11% in H1 FY25 on an annualized basis. The CAGR for the previous 4 years was 20%. Incidentally, overall retail credit growth also slowed to 13% in H1 FY25 from 4-year CAGR of 19%. The personal loans grew slower than overall retail credit loan post-March 2023. Share of disbursements by NBFCs increased from 16% in FY21 to 39% in H1 FY25. NBFCs took over the market share from the banks in overall personal loan segment. The banks are focused on higher ticket personal loans compared to NBFCs. The average ticket size of the banks further increased in H1 FY25. This probably reflects shift towards better quality customers. The asset quality of the personal loans book saw deterioration as 90 plus DPD grew from 3.9% to 5.2% as on September 2024 in the last 18 months. In the care-rated fintech space, the growth in disbursements has slowed down, moderating the AUM growth. The credit costs have slightly increased, impacting the return on the total assets. The focus of the sector would be towards balancing risk and growth for profitable operations. We have seen quite a few actions from regulator in recent past to address excessive risk building in system with focus on enforcing fair practice code. Recently, RBI have reversed punitive capital requirement for lending to NBFCs. Now, let us look at the growth trajectory of the unsecured personal loan segment. The chart on the left depicts the AUM of the unsecured personal loans in banks and NBFCs from March 2020 to September 2024. The data on the slide also includes credit card and consumer durable loans. The unsecured personal loans book stood at around 22 lakh crore, growing at the CAGR of 20% for the period FY20 to FY24. However, the growth moderated to 11% on an annualized basis during H1 FY25 and stood at rupees 23 lakh crore as on September 2024. The chart to the right talks about the growth rates of the personal loan and overall retail credit. Until March 2023, the unsecured personal loans outpaced the growth of retail loans. However, we see a trend reversal in March 2024 and September 2024, wherein Slowdown in the growth of unsecured loans is visible. Consequently, the share of unsecured personal loans in total retail loans marginally dipped to 32% as on September 2024 from 33% as on March 2023. Now, talking about the factors that have impacted the slowdown. Post pandemic, the Indian economy thrived with a robust credit cycle, low NPAs, and ample risk and growth capital. High lending confidence led companies to adopt high growth strategies, sometimes involving aggressive underwriting. The borrowers also took advantage of this benign environment and increased the leverage. They took multiple loans, adding to their leverage. As per December Financial Stability Report of RBI, nearly half of the personal loans borrower have another live retail loan, and around 11% of the borrowers had an overdue, and more than 60% of these borrowers had availed more than 3 loans only in the first half of FY25. All this has led to asset quality deterioration, more particularly in smaller ticket loans. Excessive growth rate and rising stress was a point of concern for RBI. They have nudged the lenders to slow down the growth rates, and in November 2023, RBI increased the risk weights by flat 25% for consumer credit exposures of NBFCs and bank credit to NBFCs. This has heightened this has tightened the flow of credit to the sector. We also see some shift from unsecured and more focus on secured lending in the recent times. Now, in this slide, we talk about the trended disbursements by different categories of lenders. The data in this chart excludes the credit card and consumer durable loans. The chart on the left-hand side refers to the disbursement trend for different categories of lender. Both public sector banks and private sector banks are showing negative growth in H1 FY25 compared to the last 2 years. NBFCs still continue to show slow growth in disbursement, though in this chart to the right, we clearly see that the contribution of the NBFCs in the disbursements has slightly increased from 16% in FY21 to 39% in H1 FY25. This is largely driven by the expanding business of the fintech NBFCs. We observe that while the banks continue to dominate the market with more than 50% share, both public and private banks have become cautious, as indicated by declining shares. The others category in this chart consists of exposure of regional rural banks, small finance banks, and foreign banks. Here, we talk about the trend in average ticket sizes for different categories of lender. In the left-hand side chart, we can clearly see that public sector banks have been increasing their average ticket size ever since COVID. Their average ticket size has gone up from rupees 3.4 lakhs in FY21 to rupees 5.7 lakhs in H1 FY25. The average ticket size for private sector banks has also gone up. The reduction in the average ticket size for private banks in FY22 to 1.8 lakhs rupees was driven by aggressive co-lending business by few private sector banks, and similarly uptick in H1 FY25 is reflecting slowdown in business by those banks. We see this trend of public sector banks and private sector banks as a flight to quality. The average ticket size of NBFCs continues to remain lower at rupees 20,000, driven by higher volumes by fintech entities. In the chart to the right, we can see an increase in large ticket loans. The share of rupees 10 lakh plus ticket loans has increased to 28% in FY24 from 17% in FY21. Around 116 million loans of less than rupees 50,000 make up for 10% of the value, while 4 million loans of more than rupees 5 lakh make up for 53% of the value. Asset quality has been the talk of the town, and there is too much palpitation around asset quality. Whether the asset quality deterioration seen in MFI space would have any contagion effect on other unsecured retail loans? We observe that few entities will be impacted more than others depending on their business models and risk processes. At aggregate level, we see an increase in the PAR 90 plus but this does not appear to be an systemic issue at this point of time. As can be seen in the chart, the PAR 90 increased from 3.9% as on March 23 to 5% as on September 23 in just 6 months. This significant rise prompted regulatory intervention in November 2023. This action and regulatory sidewalks prior to the action probably enabled tighter credit risk containment. There is slight moderation in asset quality thereafter, and PAR 90 increased from 5% as on September 2023 to 5.2% as on September 2024. The RBI has recently reversed the punitive risk weights for lending to NBFCs as the risk in PAR 90 has not seen drastic deterioration. The risk weights on direct consumer lending continues to have higher risk weights for banks. We also understand that the personal loans book of banks is performing better than that of the NBFCs. In this slide, we are talking about the care rated fintech while focusing on unsecured lending. In the chart to the left, we can see the 4-year CAGR of 33% in disbursements. In H1 FY25, the disbursement growth has slowed down to 20% annualized as compared to the 4-year CAGR. Continued disbursement has supported the AUM. In the chart to the right, the AUM has grown to rupees 35,000 crore as on September 2024. AUM has grown in H1 FY25 in line with the disbursement growth driven by relatively longer tenure loans. We observe that a few fintech NBFCs are focusing on increasing loan tenure. Further, as seen in the chart to the left, the credit costs have increased slightly to 9.15% in H1 FY25 on an annualized basis as compared to 8.56% in FY24, indicating relatively stable credit costs supported by continued momentum in the disbursements. As seen from the chart to the right, the return on total assets moderated to 2.11% in H1 FY25 on an annualized basis as compared to 2.79% in FY24. This brings us to the last slide of our presentation. Speaking of our outlook on the personal loan sector, we believe that a regulatory rollback of the higher risk weights for bank finance to NBFCs in February 2025 will be positive for the sector. Unsecured personal loans come with poor ability to monitor end use, and there is perceptible fear in the market that borrowing from personal loans might have made its way into equity market. Credit cost remains key monitorable for us, and we will keenly observe the impact of the recent turmoil in equity markets on asset quality, if any. Growth in the personal loan sector is expected to be muted. Co-lending share in AUM of NBFCs, fintechs in particular, is expected to increase as banks and larger NBFCs adopt risk-sharing model and leverage technological synergies from fintech entities. Liability franchise of the fintech NBFCs will continue to be supported by co-lending and private capital. Stringent underwriting and tighter monitoring are expected to be a key for maintaining the asset quality. Risk-balanced growth with sustained profitability is expected to help attract long-term capital for the fintechs. We have now come to the end of our presentation. Thank you, and now I would like to hand it over back to Mamta.
Thank you, Akansha. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Vineet Jain to take over the session, please? Vineet Jain is the Senior Director at CareEdge Ratings. He's a Chartered Accountant and Company Secretary and has over 25 years of experience spread across credit ratings, structured finance, debt capital markets, and corporate banking. He was part of the founding team of IDFC Bank and was instrumental in setting NBFC lending businesses as part of FIG. He has earlier worked with SBI Capital Markets and Axis Bank, among others. Over to you, Vineet.
Thank you, Mehta. Good evening to all the panelists and all the participants. A very warm welcome to all of you. Thank you, Akansha, for the insightful and informative presentation. We are today honored to have three esteemed panelists with us, and I thank all of them for being part of this panel discussion. I believe that we all will benefit from their insightful views on the sector. Please note that the views expressed by the panelists here would be their personal views and may not represent the official views of the institution that they are associated with. I would now quickly start the introduction of the panelist members. Our first panelist is Mr. Ashish Goyal. Mr. Goyal is a founder of Fibe. Fibe has emerged as a key player in digital consumer finance under Mr. Goyal's leadership. Previously, Ashish was associated with Bajaj Alliance as Chief Investment Officer. Ashish is a chartered accountant. Notably, he was recognized as most astute bond fund manager by Asset Magazine in Singapore from 2011 to 2013. A very warm welcome to you, Ashish.
Thank you.
Our second panelist is Hemang Mehta. Hemang has more than 20 years of experience in corporate banking and is currently Chief Risk Officer at Vivriti Capital. Mr. Mehta was earlier associated with Stancy, HSBC, and ICICI Bank. He has a master's degree in economics from BITS Pilani. He has an MBA from Accelerate Jamshedpur. He is also a chemical engineer. A very warm welcome to you, Hemang. Our third panelist is Shruti Aggarwal. Shruti has over 2 decades of experience in financial services and entrepreneurship. She is co-founder at Stashfin. Before Stashfin, she has also founded and led Secret Cache New York, a prestigious boutique in US. Ms. Shruti was also associated with Merrill Lynch in New York earlier, and she has also worked in PwC in India. She holds a bachelor's degree from renowned SRCC. She is a chartered accountant. She also has a master's degree from Columbia University. A very warm welcome to you, ma'am. In case participants want to ask any questions on the presentation made or otherwise, they are requested to queue in their questions in the panel on their screen. Now we'll begin our panel discussion and simultaneously also take questions from the panel participants. While we wait for the questions, I take liberty to start with Ashish on his views on the sector and his takeaways from the presentation that we have made. Ashish, over to you.
Thank you, Vineet, and thank you, Care Ratings, for arranging this. It's always very, very insightful to look at the presentations done by Care, and always there are some new insights to go aloud. Um, so, in last 18 months, I think since September of 2023, personal loan or the unsecured lending, including credit cards, etc., were in quite limelight, given the kind of a growth which we saw in last 2.5 years before September of 2023. ले जाइए आप. September 2023, and from that onwards, we have seen quite a roller coaster ride in last 18 months, where the industry growth has come down, as shown in the presentation, from all the way from 26-27% to now down to single digits. Actually, the December numbers are showing a 9% YOY growth in the personal loan categories, and credit card is growing at around 14%. Having said that, I think there are two, three takeaways which I saw in last 18 months. One, while there is a serious slowdown happened till now, the credit cost has gone up, but it has not gone up significantly what we have seen in the last crises. It is much more benign in compared to whatever we have seen in the past. So, which is a good sign that the industry has matured from the underwriting standards perspective, as well as overall the people's ability to pay back was also quite intact. Of course, there are some cohorts, some segments where it got hit badly, but overall at the industry level, I think the credit stress was quite managed in compared to some of the other segments where we saw very, very severe stress, like microfinance. Second, given the fact that there is almost 15 to 18 months of window where each one of us were tightening our credit policies and increasing our credit standards, as well as the CIBIL reports, which we call as CIBIL Bureau, where the data was getting updated. And last 18 months has given a long amount of time where the what we call as the credit bureau of the incoming customers has improved a lot. we think that we are now set for a good growth trajectory going forward, given the fact that there is a good amount of time correction has also happened in the credit cycle. So with these two things, I believe that there is a good momentum can be built in the businesses going forward. Having said that, there will be still a very cautious outlook at our end, not to go all out to increase businesses. We remain very cautious given the slowing consumption which we are still witnessing in the economy. Having said that, there is a good amount of opportunities in select pockets where we are seeing, and we are investing into those opportunities to see that how can we really maintain the growth momentum.
So cautious growth is your mantra.
Yes, cautious growth is our mantra. We believe that next 12 to 24 months is a nice period to grow balance sheets, as well as while ensuring that you are building it sustainably. The other piece which I will touch upon is the capital levels. The capital levels across the industry, especially in the fintechs, is quite healthy. Most of us are sitting on a much larger capital basis in compared to regulatory requirement, as well as from the comforts to the lenders. And that also gives additional comfort to the industry as a whole.
Right. So on growth, we'll move to Shruti. Shruti, if you look at recent past, RBI has been continuously sensitizing lenders to moderate their growth in consumer lending as well as in unsecured space. And if you see that since RBI action, there has been some moderation in the overall growth rate also in the unsecured personal space. What is your perspective on near to medium term in terms of growth prospect for PL space? Uh, Ashish said cautious growth. What is your take? Have the growth rates bottomed out? Do you see growth rate bouncing back to, let's say, high 30s, high 40s in near term? What's your take?
So the belief I have is, by creating a liquidity crunch, growth couldn't happen. And as the government plans to pump in 45,000 crores into the banks in form of liquidity through, lower income tax rates, and we think the liquidity will come back, which will grow the book. But this doesn't mean that you can grow the same way you have grown in the past. I think cautious growth is here to stay, not just for now, for financial services to be stable just in the short term and in the long term. There will be more regulatory changes coming in, more policies put in place so that all of us can grow together in a scalable format and provide profitability to our investors and comfort to the market at large.
Okay. So we have some questions coming in already. Maybe first question may be taken by either you, Shruti, or Ashish. That's a question in terms of collection efficiency trends. Do you see collection efficiency deteriorating in fintech space? And is there a trend of moving to higher ticket sizes to look for better quality customers? That's a question from one Miss Nisita.
I'm happy to take it first.
Yeah, please.
So, collection efficiencies, I think the lowest collection efficiencies actually peaked for us in September 2023. And since then, we've only seen an upside in terms of better underwriting, moving scale to better quality customers. Better quality customers, if they've been performing for the last 18 months to 24 months, you will see a higher ticket size. I think automatically will be right, giving higher ticket size loans to repeat customers who have shown a behavior of repayment and responsible lending. For the heck of growth, I don't think large ticket sizes are here to stay. But everyone's solving for a business, very different business model. And fintechs, where we come from, we solve for ticket sizes not to increase, but to engage with the customer very efficiently and profitably.
Um, yeah, in the last 12 months, I think the collection efficiency is bottomed out at various stages for various companies. But in last 6 months, what we started seeing three trends. One is that because of two reasons. One, what I spoke about, what we call as loosely CIBIL cleanup, or the cleanup at the bureau levels. And the second is also the tight underwriting standards. We started seeing better collection efficiencies in the early buckets. But for the few quarters before, let's say 2, 3 quarters back, we saw quite a dip in 180 plus collections or recoveries, and we echoed these sentiments across the industry. But for the last 2 quarters, we started seeing the high frequency data around recoveries, which is generally 180 plus portfolios, where we started seeing the first green shoots of money coming back from the older accounts. And I believe that's a very, very big positive sentiments, purely from a perspective that when you start receiving money from your older accounts, it shows that the market is stabilizing, people are becoming more comfortable, finding opportunities to settle their accounts, finding opportunity to find new way of starting the life again. And that's where the settlement offers, etc., I started rolling out. And in last 6 months, this trend is the one which gives me a lot of comfort in saying that we are towards the bottom of the cycle from the credit perspective, and it is a good markets uh, to grow cautious books.
Thank you,
And
Ashish.
on the ticket size, uh, generally generalized market sentiment is to everyone has increased their qualities. I think if somebody was doing X, he's sitting at 1.2x, and each one of them has increased their qualities, and we believe it is going to stay for some time before we again start going out.
Yeah, thanks, Ashish, for that input. In fact, that answers one of the questions raised by some Akhil Dhar in terms of underwriting standards changing. So everybody pretty much would have tightened their underwriting standards post tightening by the Reserve Bank of India. Hemang, coming to you, at aggregate level, we saw the data that PAR 90 has moved from 3.9 to 5%, and that was a trend from the September to March 23, right?
Right.
March 24, sorry. And if you look at after that, the delinquencies have inched up rather very slowly, right? So, do you still see some pockets of stress building up somewhere? What is your expectation or what is your experience when you interact with multiple entities on the ground? How do you see the scenario unfolding?
See, as you said, we are seeing stabilization. Initially, there was a bit of uptick in the expected credit loss levels, ECL levels, but we are seeing a stabilization. As Shruti and Ashish mentioned, there is also a move towards longer tenor loans, or slightly larger ticket size repeat customer and slightly longer tenor loans. So as we see a bit of a pivot from a smaller ticket size and a short-term loan to a longer ticket size and also a longer term loan, uh, it remains to be seen on how the credit cost or ECL moves. But largely, so far, we feel that the sector has handled it well, be it a large player or be it a small player or a mid-sized player in this space. Each one of them have seen in the credit quality or credit costs over the last couple of quarters. And as Ashish also mentioned, that people are also looking at slightly better profile customers in terms of bureau scores. So, in that sense, I can say that we are seeing a maturity in this industry. Earlier, it was a huge growth rate, but there is a sign of maturity coming in with a stabilization of credit costs as well.
Shruti, your views?
Very similar views to Hemang. Cautious growth, longer tenors, reduced rates and larger ticket size is the way to go. Behaviorally, it's performing well, but again, it hasn't peaked out yet. So cautious growth and looking at the NPLs very closely is very important to know when to pivot.
One of the risk mitigant that we keep hearing in discussions is the CIBIL score, and there are a couple of questions on CIBIL score that we still see 700 plus people defaulting, right? So, how important or how useful is CIBIL is the question that essentially people are asking. So, maybe either Ashish or maybe Hemang, if you have some perspective on that.
Among you, it's okay. Let me take this. Yes, CIBIL score at a scale does matter. I will not deny that fact. That at a scale, CIBIL does show what does it mean. But just having a 700 plus score doesn't guarantee that there will not be a default. Otherwise, the entire lending could have been very lazy lending. Means you look at the score and
Absolutely. Yeah.
I think there are quite a nuances around the entire credit score process. which is from a scale perspective is right from CIBIL or from their perspective, because the same score is used by, let's say, mortgages or the home loans, vehicle loans, gold loans, personal loans, us, everyone uses the same score, but the product dimension or the product nitty-gritties needs to be accounted for. Second, it does not take into account a lot of factors like demographics, the income levels, etc. It is just an indicator of how he was well paying in the past. And there are many of these things which leads us to point where we believe that the CIBIL score, more than the CIBIL score, the CIBIL data matters a lot, because this gives you a true picture of what's happening in the consumer. Just to give an example, somebody with a 6 to 12 months of credit history can have a 760 score, and somebody with a 10 years of history can also have a 760 score, but both of them will have definitely a very very different credit matrices at a cohort levels. And from that perspective, I think that's where the risk taking and the risk management will play a big part. Having said that, yes, the CIBIL score cutoffs generally we use for just eliminating the lower end of the consumers. Over last 18 months, those scores has also moved up within the system to from the efficiency perspective. Yeah, but beyond that, it is the data which matters a lot more than the things, because we have much larger data sets, yeah, and CIBIL files just become one of the data sets.
So
I
stable
think
is just one of
all
the
the
data
points
points. It
that
teaches you a lot
Ashish
more
has
what this
mentioned.
is costing. Yeah.
Also, what happens is one is the CIBIL score, as Ashish mentioned. Second is the inherent data that is provided through the bureau report, which has, last 3 month, last 6 month, last 12 months, DPDs, write-off. So there is detailed data over there as well. Plus, what while giving a loan, it is not just that the CIBIL score is part of it or the bureau history is part of it. Demographics, like Ashish mentioned, age is looked at, PIN code is looked at, because collection ability changes based on the PIN code. Uh, Educational qualifications, marital status. So there are various other aspects that are considered. So it's a mix of multiple data points which go into deciding on whether to bank with the customer or not.
Very helpful. I think if I look at the tone of the question, essentially the factors that you and Ashish are pointing out, a lot of it is something which can again be part of the credit score, right? So, what is the challenge around that? Is what you can reflect on that if possible. So, like you are saying that education qualification, all the longer track record, or the nature of track record, demographics, right? All those things again can be modeled, right? So, what are the challenges in building that in the city?
No, Vineet, you are right. But at the end of the day, many of this data also needs a lot of your own proprietary, because like CIBIL, which has a single track record and which is the same data available to all of us with the same scores. But the most of the other data sets are very, very unique and very proprietary in nature. Just to give an example, if somebody with a particular education plus income, etc., or might be a good customer for me, but may not be that great customer from a home loan perspective, because it's a 20-year underwriting. So all those factors will change the outcomes there for the consumer, for the lenders to take decisions around it, as well as many a times the behavior of those consumers. What I have learned in last 10 years of running this business is that many of the preconceived notions which we built within the ecosystem over a period of time about, let's say, restricted profiles, about various themes around the stories, have most of the time does not stand the data scrutiny. And we have seen that many of those challenges, some of the fintechs has actually came and challenged those kind of a premise and really build the business around it.
Examples of underwriting tightening, I think that would be, I think, too much. Uh, Like the panelists were mentioning, higher RBI tightening how important it is to invest more in credit risk methodologies. I think that's the most important thing in credit, right? How important it is to invest more in credit risk methodologies.
Happy to take that. I
Yeah.
think it's very, very important. Algorithms change, data change, the kind of products available change, the kind of companies giving products also changes. So it's important to understand what works for you and what doesn't work for you. For someone, as Ashish said, 10-year vintage will have 760, 6-month vintage will also have 760. It is all about trade lines. It's about DPDs. It's about repayment behavior, how that has changed, on what products the focus is, the number in queries, etc. All that matters when you're writing, underwriting, and pin codes. Where you're seeing fraud from, where you're seeing collection becoming hard. All those algorithms have to be plugged in very, very quickly because being a fintech, money can go out very, very fast, but getting that money back can be hard if you've not tightening your credit or looking at your credit very, very closely. So a lot of time is spent on credit, risk underwriting, and just culling out data and understanding what is working for you and what is not working for you.
Ashish, do you want to add?
So one of the things, while on the credit methodologies, I'll just add on the top of what Shruti has mentioned, which I completely agree that at the end of the day, we need to build our own risk models, etc. In my mind, the biggest thing which matters apart from building this credit methodology is also the culture of the company. Most of the times we will get a curve coming out of the analytics saying that okay, this is a curve on which we should play out, because at this let's say internal score of let's, for the simplicity sake, keep the same CIBIL score. That internal score of 700 is a good to land if you want to take a particular risk. So now the discipline of managing the growth versus credit cost in the good times as well as in the bad times, as well as having that kind of a cultural maturity within the teams to survive the bad times and thrive in the good times is extremely critical, because algorithms are algorithms at the end. Human sentiments are generally which kills the company.
Hemang, any perspectives?
No, I think Shruti and Ashish have covered it largely. See, RBI perspective is that we make a model, and the model evolves over time. So there's not a single model. Each product that a company offers, NBFC offers, for each product there is a mindset and a thought that this is the target customer segment based on which a model is developed, and that model evolves over time as you see a history on a particular model. And as Shruti mentioned, on a PIN code, there could be harder collections. Over time, more frauds happen in a particular space. So the model evolves on something as basic as a mobile number. Say there is a mobile number which is a new series. There, if you see that there is a higher delinquency, a new series mobile number, the model will pick it up. So there are times that we might not understand that what is the reason behind this model throwing this output, but there are certain trends which get picked up by the models itself.
Right. There are multiple questions linking to MFIs actually. So let me paraphrase few of them. So the asset quality is deterioration in MFI is now largely in public domain. We know what happened there. Uh, though it's not alarming as of now, is what it looks to us. We do see pockets of risk spreading into other asset classes, particularly in high yield personal loan. So, what's your view on that? Maybe we can hear from Ashish and go to other panelists. Do you see colors of this on the ground very frequently, or do you see that this risk is pretty much contained? The spillover of microfinance to other asset classes.
So, Vineet, for last 6 to 9 months, this is a question which always remained the top of the mind. We did a lot of work with the bureaus. We try to do figure out that is it something that we should be really worried about it, and of course we keep worrying about it. That's our job, to worry about everything in life. But to be honest, the data till now, whatever we have seen and whatever the thesis which is getting built, it looks like quite a localized microfinance, or more microfinance or the rural phenomena at this point in time. The most of the urban, the tier 1, tier 2, tier 3 cities, even tier 4 cities, we are seeing quite a not that kind of a spread happening from this at this point in time. Like I said, that the most of the portfolios at this point in time are showing bottoming out. The places where I believe there could be a spillover is the similarly in the geographical regions where the microfinance is very prevalent. We can see the spillover happening into uh, the classes where there might be an unsecured SME loan given to the same borrowers, or a lap against the borrowing capacity. But at this point in time, my view is that the microfinance looks like a more rural centric issue at this point in time than anything which is up to tier 4 cities.
Hemang?
Yes, I would completely agree with Ashish. So, my thought process is that the sourcing of customers and the kind of customer that you're targeting is different. One is branch-led in microfinance, and it's a women-led group. Whereas here in consumer finance, it is digital-led. Sourcing is digital. The app journey is there through the mobile. And you are not stepping into any branch, and you don't know, say, a customer is coming into Fibe. It is an entirely digital journey from onboarding to KYC to repayment schedule, KFS, collection. The entire journey is digital. So effectively, these are two distinct sets. And as Ashish said, maybe it is urban, rural, and also maybe it is the ticket size, the tenor that MFI provides. While that might seem to be a overlap with personal loans, but it seems like these are two different, distinct customer groups.
So, looking at from a little broader perspective, let's say if we expand the horizon to personal loan, not restricting it to fintech, the what we are gathering from the market is there is some spillover, right, from MFI to unsecured, though not very alarming, and some signs of spreading it to secured, again, not alarming. So it's not a cause of concern, is what we would believe or what we are hearing from the market at this point of time. Any views on what's happening in Karnataka on MFI and other asset classes? Because there also we are hearing multiple stories. Shruti, any views on that?
I mean, you're hearing this coming out of a lot of companies, a lot of geographies. So I'll refrain from commenting, but I can agree to the fact that in the fintech digital lending space, at least where we see our data, we're not seeing a spillover. We probably don't even underwrite those kind of customers. They don't qualify as a trade line for us to go forward, or the FOIA gets rejected because of over leveraging. So we're not seeing that kind of customer base, and uh, so we will not have a view on geographies or those kind of trade lines.
Ashish?
Like I said that it is absolutely possible where you are in the same proximity to the center of this piece in my mind, which is rural. If you have branches in rural and doing the SME lending or the unsecured lending or even a personal loan lending, there would be an impact. And second, many a times it will be very, very tough to attribute the differences to the microfinance. I think that's a point. But having said that, there would be some impacts coming on the segments which are very, very closely linked, like agriculture loans, or maybe the loans given against the small businesses, because at then many of the microfinance loans are for income generation, so they might have been supplemented with other loans also. Only thing where the good part about one of the other category of loan in this category is the gold loan. Yeah, given the gold prices, at least that industry should weather well, purely from the perspective of the LTVs, etc., should be quite decent there. But yes, at least I think it is very, very uh, thing. And on the Karnataka ordinance, our view, and which we expressed to People also is around the piece saying that while it is not applicable to the NBFCs and the RBI regulated entities, it is more about the unregulated entities on which it is an impact. But on the ground, we have not yet seen any impact, but we are watching it carefully to see that whether the execution challenges comes.
Yeah, and there are again a couple of questions on RBI action, which they took maybe 6 months, 12 months back on few of the entities. So I'll just club together them questions and then probably we can put it to one of you. So uh, there is a fair bit of focus that RBI has put on fact practice code in the context of NBFCs. This code always existed. The implementation probably for banks was far more rigid. Maybe they were slightly relaxed in the context of NBFCs. They have put their focus on fair practice code, and they have recently taken action on higher interest rate and the credit model, where it is sitting, how it is sitting, all those things. So the question essentially is higher interest rate concern of RBI on higher interest rate. Is it changing the business model? How it is changing, and what is the view of let's say panelist on this? How it is impacting the business models of entities, specifically on the interest rate concerns that the regulator has. So, Ashish, would you like to take it?
So, if you look at RBI over last few years and especially over the last few quarters, has clearly articulated their viewpoints around how what are the things which they really like to see in every company which is operating under the license taken from them to give to manage the financial inclusion. I'll divide into three parts. First is which is at the topmost is the customer protection and the transparency. In the last 18 to 24 months, I think the amount of direction came through KFAs, through fair practice codes, through interested disclosures, through putting policies on websites, to giving full disclosures to the consumers, looking at the customer complaints, very, very proactive on the complaints which are reaching out to RBI, and RBI is proactively working with the institutions, calling every quarterly the various stakeholders to take them through what's the initiative RBI is taking. I think that is the first piece where RBI is very, very focused on ensuring that the customer protection slash customer transparency education is top of their mind and they want to do it. There, many of us, all three of us are a part of FACE, where FACE is doing a lot of initiative works towards ensuring that there is a fair practice codes, code of conduct, interested policies, etc. are in place, and guiding members as well as many of the larger companies has already been doing a lot of interested things. Second is compliances. I think one of the things which is become very fairly clear to us is that compliance is no more a cost. Compliance is a past part of the business, and as you become more compliant, you also see the value coming out of it. Like we have seen immense compliances, while there is a large compliance team, but that also led to us to do a much better underwriting and much better work. Third, which we spoke about interest rates. At a company level, we were always in the interest rates which we believed that was a fair, reasonable, and we did not really make a lot of changes in our interest rate models post the changes. But at the industry levels, I believe, and this is more of the things which I hear and I talk to people, is about there are general concerns around interest rate disclosures, which is more concerning to RBI, as well as really where the interest rates moves extremely high, and the definition is little not clear, but it is more of a art. But many of us or many of the people have did reacted to it, and there were RBI direct action also on because of that, both on microfinance companies and also as well as on the NBFCs. I believe that has put a lot of awareness and the sensitivity in the minds of all of us. All of us means I'm saying the industry around the interest rate pricings and thinking around how do you really charge to the consumers. Having said that, I think that in a long run, at the end, demand and supply will work, and demand and supply will find its ways to ensure that the pricings are fair for the consumers as well as to the business.
Yeah, so our understanding is quite similar to what you're saying. It's more about disclosure and fair practice code is what it is. There have been entities which were probably lending at higher rate. The concern probably is on how you are following the policies, etc., is what we believe.
Absolutely.
Shruti, anything you want to add to this?
Yeah, so the business models generally work on risk return. When you become very, very tight with your credit and you're getting the cream, the return goes lower. How the business has evolved, that the risk return is now become a side question, but empirically or just visibly, if an interest rate looks very high, even though the risk coming out of this is high, you will not underwrite that customer. So today, all of us are talking about 700 plus bureau customers. We are actually not talking about those who probably have done mistakes in their bureau in the past or are new to credit because they inherently come with risk. But to compensate for that risk, the interest rates have to be higher. What we believe in the current scenario, we'll continue to look at more the interest rates, but at some point in time, RBI, when it sees that folks are not entering the mainstream credit because they're not being underwritten, which were being underwritten by fintechs, even after full disclosure, etc., things will open up. But at this point in time, for next 2 quarters or maybe the next financial year, it is all going to be a focus on the top line, a top line that looks reasonable and is sustainable and is stable. So that's one of the things which have come out from our understanding of all the actions that have been taken. And the second thing is, of course, if something is looking cute, it is cute. Fair practices code, uh, underwriting mechanisms, uh, unruly practices for collection, reaching out to folks through social media, reaching out to folks through friends and family. If it looks strong, it is strong. And I think RBI just trying to create that ecosystem where it is clear that no fraud happens, no leakage of information happens, and every human being is treated with integrity. I think the 1600 number introduction, the 1400 number introduction are all actions toward the right format where the customer should feel comfortable taking credit and not fear taking credit. So that way, we think more consumers will come in, but of course, the focus will be on underwriting the best that meets our criteria.
Just a minute. Hemang, your views?
Absolutely. See, on the interest rate, I think Ashish and Shruti have covered it. And RBI, view is not just on this interest rate, but it is a larger view on fair practice code in terms of providing the key fact statement to the customer, providing that in a language that the customer understands, setting an internal benchmark or a ceiling which is board approved in terms of the interest rate as well as the annualized percentage rate. The difference between the two is, include all the costs which are there that the customer is paying for. Of visibility to the customer in terms that is important, and through the journey, collection is the point that Shruti covered. So all through the journey, the customer is aware, informed, he knows his rights, he knows his obligations. So as a package, that is something that I think all the NBFCs are significantly investing in. And this is also a journey. Um, 2 years back to now, we would see that there is a significant investment that has happened in each NBFC on each aspect of this plan. So uh, each point is discussed during our board meetings, and how we are improving on that quarter on quarter, that is also being discussed as well.
There are two more questions which are again coming multiple times in the Q&A box. One is on ticket size linked to delinquencies. Second is on the stock market correction. So lower ticket size of less than 50,000, do they show more delinquencies? Probably the answer is yes. Another question is stock market turmoil recently. Do you see that impacting the personal loan asset quality? These are the two questions. So any of the panelists can take it.
I think there is no, it's not the first time that less than 50,000 rupees, more than 50,000 or 10,000 delinquencies are behaving differently. It's a very well universal truth that as your ticket sizes goes up, delinquencies has to come down purely because you will give money to a larger, means higher income customers, the better quality customers, the larger set of money. The question is about whether the money which you are giving, the income which you make is offsetting the credit cost which you take on that portfolios. Yes, in last 12 to 18 months, I think uh, you can say less than 10,000 would have hit, worse than less than 25,000, worse than 50,000, and so on and so forth. So everywhere there is a credit cost has gone up. In my mind, it's true for every bucket, just not for less than 50,000 rupees. Second, I think it is too early, given the fact that the stock market correction is just very, very fresh from a looking at from a delinquencies perspective. Again, I'm talking more of the industry perspective, not only for the fintechs or for us in particular. I think it will take some time before it will percolate down to the in the personal loan markets, because while there is no anecdote evidence, but there is a good amount of um, uh, uh, people have spoken around the fact, and there is a speculation that a lot of their personal loan money has gone into the stock markets. But I think it is just too early from that data to look at to get that kind of a data from anybody or a commentary.
So, Shruti?
When we speak to other players in the market and we speak to lenders, we hear this that personal loan money or money of any kind, once it's in the bank account, it's almost impossible to understand where the funds are being used for, whether for livelihood, for consumer usage, or for stock market. But, you know, assets which could have got probably an LTV, your LAS, your mutual funds, etc. I think that margin calls have started coming. But is it driven by personal loan margin calls, or is it personal loan money that has driven those margin calls? It's just the crash of the market or the volatility in the market, the nervousness. It's difficult to tell. But the general sentiment is that yes, stock markets have made it a little difficult for personal loan players to grow, just because we're not tracking end usage all the way.
In terms of competition, do you see more players getting into the industry, or do you see the trend of consolidation in the industry, Shruti?
Um, so we think there's been a fair bit of consolidation so far, with Amazon, Axio, Zest, DMI, Home Credit, TVS. I think there's been a fair consolidation. Competition that way, competition always is healthy. It forces you to become better. But as regulations becoming tighter, we see less people coming in. But I think with banks, NBFCs, enough regulators and enough players already in the market to actually drive growth and to give us competition.
Ashish, any thoughts on this?
Completely means I think um, more than consolidation, I think I believe that there will always be new players which will keep coming back to the systems. There is always a room. India is a very, very large market. We all are, each one of the entities are still very, very smallly contributing to the businesses. And there is always an opportunity for the right set of business with right set of founders to start the new businesses, and they will continue to build partnerships.
Specifically on fintechs, the business model is truly digital, right? And physical footprints are very, very limited. And success of lending business is in your ability to collect money back, right? So in that context, do you see on a longer term basis need for fintech to have physical collection infrastructure? Do you see that happening in medium term? Do you think that the business models are attuned to absorb that kind of cost? Would be viable with those costs? What's your view?
I think there is no collection businesses which can be built without physical infrastructure, whether that physical infrastructure is yours or you take help of the agency physical infrastructure. there is a very well-defined collection infrastructure built across the country. Only unfortunate part is that most of these are regional players. Unfortunate, fortunate is a way to look at it, but most of them are for regional play. From my perspective, I think collection will have a legs of both the digital and physical. In digital, there is a lot of work has been done by each one of us in our own wisdoms into our own portfolios about the building algorithms, propensities, building ability to reach out to the consumer faster. How do we really ensure that there is a more efficient way of running the businesses? But I don't see and like with that today in last, like just to give a very anecdote point, in last 15 to 20 days, or let's say last 1 month, at least five collection AI companies reached out. Couple of them just got funded and announced in last 1 month. And there is a lot with AI, there is a lot of excitement coming in the AI as well, in the collection as well as in the customer service side, because a lot of the work can be automated or the calling can be automated. And we believe that there is a large amount of technology disruption happening in the collection itself. With that, having said that, there will always be some physical lags which will be there. I don't see now those physical lags will change as time goes. You become very large. You feel that it's better to build those legs ourselves. Till the time if people are small, they can just rely on the agencies to do that piece.
Shruti, your take?
We have a slightly different view on this. We think it's more about educating the customer. As far as your loan is not gone in the wrong hands, that means not an identity theft, money does come back, but the customer probably doesn't know the impact of not paying. So, spending more money on educating the customer, making sure your bureau is updated, the impact that bureau would have on your livelihood or your aspirational living is very important. And if you can do that and have a system where, you can educate the customer, your legal system works well, the money will come back. Physical or non-physical will not matter. It's about really, if you're underwriting the best quality customers, they may be going through a tough time, but the money should not land in the wrong hands. And how the system should be built out, and I think RBI is spending a lot of time doing that, educating customers. For your phone bill, when you call someone, it all talks about fraud, etc. Now loans are also being put in the same bucket. So I think it's just educating the customer is much more important than spending money on physical built out of collections.
Hemang, we deal with a lot of entities, right, in this space. What's your take on this? How critical is to have your own collection infrastructure? What's your take?
So essentially, it depends on the customer segment, the ticket size, the PIN code where they are, and the past track record of the customer in terms of when he or she has paid. So if it's a customer that has paid on an average with a delay of 5 to 10 days in the past, then the track record is that the customer would eventually pay. You just need to nudge them through a phone call or through a message, and they will eventually pay. Versus a customer that has defaulted in the past and has become sticky, and or maybe it's the first time he's entering into a delinquency bucket, and he's just worsening in terms of the credit, DPD. Then you might need to invest in a physical collection agency. And if the ticket size is meaningful, then there is a risk reward in terms of engaging the physical agency and being able to collect. So depends on the size of the loan, the PIN code where it is, and the past track record.
Okay, thank you. And there is a question on Chinese app. Is our fintechs forced to go aggressive because of competition from Chinese? I think that's already done, right? RBI has already blocked all Chinese apps. Correct, Ashish?
Yeah, so RBI and to large extent Face has also worked towards the so last 3 years, I think FACE as an industry body has worked very, very aggressively along with RBI and Google to remove a lot of Chinese app. If I remember right, last time they spoke almost 2,500 apps has been removed. Uh,
2,500. It's a
well,
large.
Google and RBI has also created a framework where any app which is coming up into the Indian Play Store market needs to have the NBFCs, their registration certificates, etc. So I think that it's much more cleaner now in compared to what it was earlier.
Shruti, your take?
Exactly the same take. I'm not hearing about it. I think what had to be done has been done. Yes.
And Ashish, the growth, if you look at fintech space particularly, it has been supported by A, CLM, and B from capital market, private capital in the debt capital market. Do you see this trend continuing, or do you see changes, structural changes on the liability side for fintech entities?
So the I think many multiple factors has really created this structural positive impact of this entire bond markets. Uh, After the change in mutual fund capital, the taxation guidelines, suddenly we started seeing many of the large capital people to start figuring out how to they really invest into the what we call as the high yield credits funds or the companies, and many of them have also started setting up their family offices or hiring professionals to run their entire wealth, and which is a good outcome purely because then your decision making has become much more professional in compared to earlier, depending upon your wealth advisors, etc. Now the large family offices we are seeing setting up a lot of these things. So that's the first thing. Second, also RBI is continue to nudge everyone saying that, "Ki, how can you access the bond markets instead of relying on the bank channels?" While bank channels will continue to remain very, very large portion of our liability management, but we think that the bond markets will continue to remain a substantial source of our funding, purely because of the fact that key one, you reach out to very, very diversified set of investors. Second, also it provides you an ability to tell your story or tell your entire thing to the much larger base, which becomes aware about what's happening in the companies. So from my perspective, I think we are in a position where both of these markets will keep on deepening. Based on my earlier experience, both the markets can go through their own moments where it can be sometimes shallow for a few months, etc. But ultimately, I think this change is going to be sticking around here for a very, very long time.
Shruti, your take?
Um, SEBI has been very, very active introducing the 10,000 rupee loans, bonds for folks in the retail. It's basically making wealth accessible to everyone and then allowing it to be traded in the secondary market as well. And with the new guideline of 25% of your capital to come from capital markets, I think it's a very positive sign that, regular Joe should be looking at the markets, looking at companies, and be able to put their money to work the way they would like to. We do access that market, and it would be a very large part of our borrowings going forward. And private credit in the form of AIFs, in the form of other NBFCs will continue to be a large part of it, as liquidity has shrunk in the banking sector for some time till it opens up. We think we would need access to capital markets and private credit to grow the business the way we would like to see it grow.
Okay. I think we have also the time. We'll take one last question and then we'll close it. So maybe Ashish, RBI increased risk weight in November 23, and with a lag, we saw that credit growth came down on the unsecured personal space. Now they have again reversed part of the tightening that they have done. How do you see this? Do you see this growth coming back sooner, or do you see this more of a pricing? So, is it more? Would it help in terms of liquidity, or would it help more in terms of pricing? What's your take on that?
So I think both, or rather, the both the sides are going to play together. The liquidity in the market should ease out for us, where we are accessing the liquidity, as well as our firm belief is that along with the risk weight reduction as well as the recent repo rate cut, both of them should create a positive reduction in pricing also for the borrowings which we do in the markets. From the growth perspective, like we spoke in the earlier questions, I think the growth in our mind is going to remain cautious. We will grow, but the growth will remain with a very, it will be quite cautious from a risk perspective. I think what these two indications of repo rate cut plus credit risk weights control is saying that okay, RBI has taken an action when the growth was at 30%. Now, as the growth fell to 19%, they believe that they achieved the what RBI set out to do it, and they want to bring the normality. So, 125% was you can say a step taken with a purpose. Once the purpose is achieved, they brought it down to the normalized number, which is also a good indicator saying that there is a, a point of view that personal loans or the unsecured lending does have a place into the entire ecosystem, and these the steps which RBI has in, or the tools which RBI has in their armory to put it, they use it when needed, and once the purpose is achieved, those actions are also been reversed.
Shruti, your take?
Very similar take. I think the Indian government has done a great job with the regulators in proactively addressing the challenges that pose the unsecured lending, both at the time of November 2023 and at the time when liquidity tightening was felt. Through a combination of stricter regulations, enhanced oversight, policies aimed at improving bank liquidity, the authorities have done a great job in stabilizing and securing financial ecosystem and making sure it is here to stay and we all feel and embrace it for the long term.
Hemang?
Yes, I agree with Ashish and Shruti that there overall there'll be a greater resilience of this sector of the system. One is the risk weights have been reduced. There'll be greater source of liability and the pricing for the liability. Second is overall customer interests have been taken care of. Mis-selling has been curbed. There's a higher focus on profitability, lowering of OpEx. So lowering growth rates is not that the AUMs have come down. It is just that the growth rates have come down to some extent. This induces some short-term pain, but overall it lays a solid foundation for stability. So I think as the industry matures, we are seeing signs of the industry taking care of the customer, and we are all here because there is a customer. So in that sense, it is a win-win for all.
So cautious growth and compliance is one thing. These are the two themes that probably we are running with. With this, we'll close this. Thank you for all the participants. I hope you have benefited from the views of the panelists here. Thanks, Ashish, Shruti, and Hemang. Thank you.
Thanks, Vineet, for hosting us.
Thanks.
Thank you.
Thank you.
Thank you, Vineet, for moderating the session, and Akansha for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.